Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, Schalk, Louw, PSG Wealth Old Oak, Grant Nader from Benguela Global Fund Managers. Be sure to send questions through. You can email us at stockwatch@bdtv.co.za, SMS 41392, or on Twitter, Business Day TV, #Stockwatch. Gents, appreciate the time. Grant, let's start with you. Let's start with Tiger Brands. It is seldom. Turnarounds are dime a dozen. They just don't often quite turn quite so quick or quite so successfully. It really was a good set of numbers that came out, and the market loved it and has been loving it.
Yeah, exactly, Simon. It's fantastic. They've got two massive tailwinds. One is all the food producers are actually in a good space. Input prices are falling. They're starting to capture a bit of margin. They're even seeing more volume growth. But then you take a management that has put a plan in place, and they are delivering on that plan faster than expected. So the investment case, if you go back a year and a half ago, was Chart Kruger's going to come in there and he's going to do X, Y, and Z.
Yeah.
Some believed it, some didn't, but he's doing it, and he's done a huge amount of it. The margin projection, you've seen the margins grow faster than expected. I think it's excellent, and I can't glow enough about it. It's lovely to see an actual plan being put into place, and it shows you the power of a capable management team when they get it right, and a genuine turnaround. So yeah, I think it's a fantastic result. We could talk to details if you like, but at a high level, it's proper execution that we're seeing here.
And a stock that's up almost doubled in the last year. Schalk, is there still value here? Because the food producers have had a great time of it. We've seen Astral running, we've seen some of the others. But I mean, what's for 2026 perhaps?
Yeah, that's the big question. And I always like to answer you. I'll tell you next year. Is there still value? I mean, yeah, I think historically, if you look at the valuations currently, it's getting better on the expensive side. And just, I mean, to note, I mean, they've come out of a very, very difficult period a few years ago. We remember the listeriosis. That's still very much part and package, of the company. But I mean, as Grant said, a phenomenal set of results. I mean, stable revenue growth, solid margins, and for the dividend seekers, I mean, what a great dividend! I mean, we're going to see eventually 16.44 normal dividend and getting close to a 40 rand special dividend. I mean, that's always a good thing. And I always say the tribe has spoken. Mr. Market has told us this morning they don't only like the set of results, they absolutely love it. Currently being up 8%. So that's it's really good, and the outlook seems to be stable. Not one that I'm owning. Question is, do we still see some value in some of these counters? Remember, we went into 2025 very much like we're sitting now, worried about markets, worried about valuations, really worried about pullbacks. And these type of companies, these defensive, these staples, are really some places to go and hide, because ultimately people still need to eat. People still, but you need to. If you can find it in your kitchen cupboard and find it in your bathroom cupboard, you'll most probably find it in a defensive portfolio for now.
Yeah, and we came in last year was all about the Mr. Prices and the like, and this year has been, it's been gold, and it's been some of those food producers. Grant, do you think there's still value here? Is it a case of if you enjoy it, but perhaps you've missed the bus? Because I like Schalk, I'm sitting on the sideline in awe.
Look, I think they still have work to do. I think there's still upside in the operating metrics. In terms of the valuation, it's had a nice run. I think you could probably take some profit if you've been in it for a while. If it pulls back at all, it's probably worth, I think you could still buy it, because you just need to look at Premier's roadmap. Premier's been fully priced for about 3 years, and they continue to expand margins and continue to grow. This guy's come from Premier. He's got the roadmap. They're still going through that journey. They haven't even finished those bakeries. They only come online in 2027. So I think it's a 2-3 year story that's still playing out. And I don't think the story's over. if you can hold on for 3 years, I think there's still value. If you're thinking shorter term, you can maybe wait for better entry levels.
Yeah, okay. We got a question around what happened when you're making lots of money. We'll get to that in a moment. I want to touch on the other set of results out today. Schalk, Vukile, I mean, good results, but I mean, no one expects anything else from them, right? I mean, they got their Spain, they got their township businesses. Schalk, this is kind of Lawrence Rapp is kind of, he's put himself into a corner. It's a comfy corner, but a corner with high expectations. And my sense is those numbers met it.
Yeah, no, definitely. I mean, a solid set of results, and very much like we've seen, like many of our let's call it retail or property local property counters, really very good. Solid set of growth, and when you look at the vacancies, that is looking pretty good. I mean, but the question currently is looking at we originally we were talking about these rates that really been underperforming. We're talking about 2 years ago, and now and giving really solid dividend yields or interest yields, forward dividend yields. Where we're sitting now, we're looking at Vukile sitting at more or less a forward dividend yield of 6.5%. So yeah, I'm starting to ask the questions. I mean, it's really been good, and you can see the let's call it reaction in the market has been good. But I mean, it does now get to a point where we've seen great performance in some of these property counters. Just be a little bit careful now going forward.
Yeah, I mean, last year the sector did plus 30%. October this year, it did plus 10% in a single month. It has been, Grant, it's been, I mean, the REITs, I mean, they peaked in late 2017. It was a horrid time for them, pandemic. They were really cheap. They've kind of got my sense to the point where they're probably fairish. In some cases, the yields are quite low. Vukile, I mean, it's a great business, but great businesses are, a 6% yield is not the juicy numbers we were seeing in the low double digits 2 years ago.
Yeah, without doubt. This one's been in the sweet spot. As you said, they've got that Spanish retail portfolio, and they've got the SA positioning, which is fantastic. But they've all benefited from this the strengthening in the long end of the yield curve in SA, the cost of finance coming down. So there's been a re-rating. How much more is left? Maybe a little bit if we see a few more cuts, but I don't think the fundamental, the fundamental revaluation case is supportive much more from here. So yeah, I wouldn't be entering new positions here unless it's one of the laggards. Certainly Vukile is not a laggard.
No, Vukile is not a lagger, absolutely on that. A question came through around Pepkor. I like the number, I like the results. I particularly like Flash. I hold the stock. Should I worry about credit sales increasing as a percentage of sales? Grant, they are pushing it higher. I mean, they're what now, sort of mid-teens. I think it's 16%. It was 14%, and before that 11%. Should one worry about those credit sales, or do we trust Pepkor to keep their hand steady?
Yeah, I don't think it's a worry yet. You do need to keep an eye on it, though. That has been a big driver of their growth, and it's driving the fintech. And I was reading they sell 8 out of 10 handsets in South Africa. I mean, it's a staggering number. Who's selling the other 2 out of 10? I mean, everyone sells cell phones. So I think they're doing a tremendous job. Their fintech offering is going from strength to strength. I think you can stay with it. Obviously, I think it's a valid question. Watch that credit book, watch the provisioning, just to see that it doesn't get out of hand. But we are moving through a rate cutting cycle. So this is the right time to be opening the taps.
Yeah, that's a good point. Rates are down 150 points, 1.5% from the highs. Schalk, for you, Pepkor credit, I mean, they are an astounding business. They're not just, selling us some cheap clothing. As Grant said, cell phones, the Flash business. Would you worry about the credit?
Yeah, the amount of increase that what we've seen in the credit sales, they should maybe consider starting a bank.
Another bank.
Another bank. But I mean, I got excited because I mean, very similar to the likes of Shoprite. I mean, they've been going from strength to strength. They've really been focusing on key areas, and they've been doing this really well. When you look at the revenue growth, 12%, and yes, we've seen the credit sales increase. And when you look at a number, credit sales increased by close to 30%. That is a lot, especially if you compare it to the 6% growth in group sales. But then again, I mean, that's like you said, it has gone from 14% to 16% of total sales. Just something to maybe just monitor. But I mean, I got excited about the other things. I've been going from strength to strength in terms of acquisitions. They're going from strength to strength in fintech. I mean, Grant just mentioned the cell phone sales. I actually like the company, not a holder. I hope it's not one of those Capitec scenarios where I'm going to tell you in 10 years' time it's the one that got away. But I mean, it's definitely one that's on my radar.
Yeah, I hear you. It's on my radar too. I'm not holding it either. A question came through. I'm looking for stock that will benefit from improving GDP and construction, particularly sort of base materials. Is Afrimat or PPC worth a look? Schalk, the minister's saying 1.8% for the next 2 years GDP. Not a lot, but it's probably 2x what we've had the last decade. So in that respect, it's not bad. Would you be looking for Afrimat or PPC if you were looking for better GDP and therefore sort of construction spend?
It's a tough one, Simon, because it's I mean, you know, you're talking to a gold bull, and I'm going to call your construction side, construction company cyclical, but yet I love gold. so maybe contradicting myself a little bit, but. I mean, both these companies have been struggling. I mean, funny enough, Afrimat, one of the struggling areas was the cement area. But both these companies are really focused on getting on the right track again. And I mean, PPC, they've got this saying, it's something like awaken the giant or something like that, where this is the strategy they get to actually go full steam ahead. And when you look at the set of results that came out last day or so, it does look good. It does look like they seem to get the let's call it the cement sales back on track. They've got this Western Cape plant that's we've got everybody excited. But it is a company that's currently up 1% in a year where the Aussie has done 36%. When I look at Afrimat, however, I mean that's a company that's down 46% year to date. So if you tell me I can't be in between and I need to choose one of the, I'm gonna most probably choose the Afrimat. Great management team. They do have the cement side, which PPC is focused on, but also they've got the other. They've got the industrial metals, which I do think will benefit from different areas if the GDP should improve further.
Grant, an Afrimat or a PPC? I mean, on the one side, Afrimat, top management for acquisitions. PPC, another turnaround that is working, that is turning.
Yeah, I mean, look, PPC, I think, has already done a large part of the turnaround. So I think they're further down the road. Afrimat's picked up a lot of turnaround that they need to do with their cement acquisition. So there's opportunity there, but they've got some complexities around the iron ore side of things and the attachments to Sasol. So there's a few moving parts there. It's a bit more complicated, but I think the upside potential is a bit bigger there if they get it right. What I would also look at is maybe Raubex. Your viewer said what else is potentially in that play. If you're going to see the GDP hit those numbers, you need to see government start to move the needle on infrastructure promises, and Raubex will be one of those beneficiaries for sure. It's also trading very cheap, and it doesn't have a whole lot of headaches, and it's not a single line business either. So that would be something to look at.
Okay, I like that as well. So, Grant, earlier you mentioned around taking some money off the table. A question came through. I bought Alphabet earlier in the year. Now it's almost 100%. And actually, I also bought some Alphabet earlier in the year, and it's also nearly 100% up. Do I hold on or take some profit? It's a great place to be, right? You bought a stock and it doubles in a short time. Winner, chicken dinner, but it's also a scary place to be. I mean, do you take some profit and leave the rest? Do you just say, hey, let's let this run?
Look, timelines matter, and how big it is in the whole portfolio matters. I would take a little bit of profit purely, but I would hold on to substantively that position. It is moving into, it's well positioned. It's almost apparently positioned as the best AI player across the board. They have strength in every single vertical. This new announcement around their TPUs as a competitor to NVIDIA. So, I mean, this business is just going from strength to strength. The Gemini product is unbelievable. I use it a lot. And I think it is one you need to have in your portfolio, and you need to have it as a core long-term holding. But you can have a trade around position, take some off the top. If it pulls back, you can buy some more, etc., etc. So don't be too greedy, but also remember to water your flowers and cut your weeds, and not the other way around.
Yeah. No, absolutely. And I got to say, the Gemini 3 and Nano Banana has leapfrogged ChatGPT by a long way. Now, there'll be more leaping coming in time. But for you, Schalk, when a stock is run, I mean, Alphabet is not, some little dodgy company we've bought. This is a proper, real, almost a 4 trillion rand, $1 trillion stock. Your thoughts when your stock gets perhaps better than you'd hoped?
Well, so let's just get this right. You bought some this year. I know, I bought some this year. And that's when I listen to Grant, it seems like he bought some this year. But there was another individual.
2 years ago.
Oh, there we go. Great stuff. But I mean, there's another individual that's bought some Alphabets this year.
Mr. Buffett.
There we go.
But he's late to the party.
He's a bit late. He's not as early as Grant. But I mean, definitely. To the reader's question or the listener's question, I mean, should I be holding? I often say when somebody like a Warren Buffett or Berkshire Hathaway buys a company, that would not typically be the time where you want to be selling the company. I mean, that's typically a telltale sign to be holding the company. They've been doing the right thing. I mean, the cloud business has also been phenomenal, very in the forefront of AI. So yeah, I do agree with Grant. One of the companies that I think should be in every portfolio.
Yeah, absolutely. And I mean, it's no longer the cheap dripping roast it was earlier this year, last year, but PE is still only a little over 30, which is a lot, but not for a tech AI stock. Schalk, let's stay with you. A question around Stefanutti Stocks. Man, I used to love this company way back, 15 years ago. Not so much anymore. The question is, anything there, or is just all about Eskom wins, and essentially they keep on winning court cases? Is there sort of business in Steph Stocks that's worth looking at?
This is not one I'm looking at, Simon. It's definitely one that I've lost touch. This has been a welcome, payment for them. When we look at their debt levels, and they've mentioned that they're going to use the payments and any future payments. They're going to use this to repay legal cost and do these debt repayments. I don't know. It's the rest of the company. I can't really have a proper opinion on. I do feel sort of uncomfortable when somebody says, "Well, I'm only going to use the cash to repay legal cost and finance cost." I would like to see a little bit more. And I didn't see that in any of the recent updates.
Yeah. Grant, any further thought? And it is telling as well that this was once a darling stock and isn't, and that's perhaps part of its problem.
I remember it, but I don't know anything much about it nowadays. What I will say is if I was going to play in construction in South Africa, I would buy the best of the best. I wouldn't fiddle around because it's been a graveyard for many companies in the last 15 years.
Yeah, and it is share price is back where it was a decade ago. Giving me a nice smiley price over 10 years, not a good sign. Grant, question around City Lodge, finally catching some love, almost exactly what I paid for it 4 years ago. Is it worth holding at this point in time?
They might be through the worst. It might be worth a hold. So to the extent that they're going to capture some of the tourism, I know their main market is also a lot of business travel. But they also haven't refurbished their offering. They're starting to do that now.
Yeah.
So from the little bit I can see, they're doing some things right. I think it's very late in the day, but the foundation seems to be improving there. So, I mean, a small position is probably okay. There is apparent value. I don't think they're well placed, though, to be, I think someone like a Sun International or a Southern Sun has a better core portfolio that appeals to more of where the value and the opportunity is right now. And you can see it in the occupancy rates. So if you've got it, you can hold on to a little bit, but I wouldn't be buying it myself at these levels.
Schalk, the results, I think last week, maybe 2 weeks ago, they did talk around October being occupancies back at World Cup 2010 levels. To be honest, it was too lazy to go and look at what the World Cup 2010 levels were. But your thoughts, I mean, City Lodge, I'm looking at the chart. I mean, it is just sort of going between, I don't know, 4 Rand, 5 Rand for the last 4 or 5 years.
Yeah, going nowhere slowly. But they've came out of a really, really tough environment. Most of these hotels we've seen in that 2020, 2021, Sun International doing rights issues to pretty much just stay alive. We know that City Lodge gone through a really tough time, and you don't just recover overnight, through that. But as Grant mentioned, occupancy is definitely looking better. 57 odd % last year, now over 62%. So that's an improvement. Things that I thought I actually liked was the fact that they're starting to close these non-performing hotels. And this year they've done exactly the same. They've done the same. So and they're doing the little things right. I mean, if you look at last year we looked at this, the food and beverages side. That's where you just go into the hotel and go have a breakfast or go have a lunch. You can see that they've improved that offering, really solid growth in that regard as well. So, would I be going out and buying myself some City Lodge for now? I don't think so for now. I would like to see some more recovery in that regard. But definitely one you could just maybe monitor for the next year or so.
Yeah, and I misspoke. It was Southern Sun who said they had the best occupancy since the World Cup. A question coming through around Sasol. This has been your pick at times, Schalk. How bad is the weaker oil price in rands for Sasol?
Yeah, it's a tough one. I mean, I've read a lot of reports where some people are of the opinion that they're more sensitive towards a weaker currency than a weaker oil price. I think there was a report by Standard Bank where they actually looked at these any improvement in the currency, and they looked at a 10-cent change in the currency to the dollar. They're looking at more or less a 600 odd million rand difference in the EBITDA or the EBIT, and then when you look at the oil price, $1 difference in the oil price will make more or less a 700. So it's neither here nor there. I think both will. If we see an improvement in the oil price, that will definitely help them, and a weaker let's call it rand environment, which we don't see currently, a weaker environment for them would not benefit them as well. That said, I still think that they're definitely leaning towards the chemical side now, and I think eventually they'll be less sensitive towards the oil price going forward.
Yeah, okay. Grant, we get your take on that next time. We need to go to stock picks. SK Hynix, I didn't know about this stock at all. Memory, and what AI needs is memory. But tell us the story for SK Hynix.
Yeah, I mean that's it. Really, it's a low it's a value offering in the picks and shovel of the AI space, right? So none of these GPUs, these fancy accelerators that Google and Nvidia are building, can operate or process without the data to feed them, right? So otherwise you've just got them standing there being throttled. So memory and the capacity to transfer data from memory into the processors and back again is a critical piece of that whole AI build-out infrastructure. SK Hynix is the market leader globally. They have about a 60% market share. There's other, Micron is also there. You're getting on around 8 times next year's earnings. It is more cyclical, but if you think this AI cycle is going to be more protracted, this build-out, and it's not about who wins, because all winners need the memory. It's not just if Nvidia wins and Google, or if Google wins, then they win. The whole build-out requires the memory. So this is a cheap way, maybe lower risk value play into that picks and shovels of the AI build-out, as long as you think it lasts more than a year, because these things can be cyclical. So that's my pick. They've got there's a shortage of supply, and it's actually very cutting edge at the very highest node. So they're operating HBM3. There's HBM4 coming out. Only a couple of companies in the world can produce these chips. So they've got a decent moat there, and there's a lot of demand. So that's my pick.
Yeah, up on ScanDisk and the others who, no disrespect to them, they make hard drives. I mean, this is DRAM and fancy stuff. Schalk, AB InBev.
Yeah, I'm going to make it a quick one. Beer. It is summer. I'm sitting in Cape Town, and it's most probably about 30 odd degrees again. So, yeah, maybe I'm just talking my book. No, it's one of these companies that have been under pressure. We've seen again today in a market where we've seen a strong market. We've seen Anheuser-Busch being under pressure, and I think for good reason. There was recent updates have shown people are drinking less beer. But I still believe, I started this program off by saying that I like to go defensive, and Anheuser-Busch at these current valuations, never been a company that's been phenomenally cheap. But nowadays, when you look at the forward P of below 15 times, they're sitting with a great cash flow. I mean, $6 billion worth of buybacks that they've done. The past 24 months. I mean, it's a company that's healthy and improving, and definitely at current levels, I would buy some. Let's call it some safety. I would definitely buy this into my portfolio as an alternative to some of these growth stocks.
And you buried the lead. We beat India. Another good reason to have some beer. That's all for Stockwatch today. Thanks to our guests, Schalk, Louw, PSG Wealth Old Oak, Grant Nader from Benguela Global Fund Managers. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.